Hey there, welcome back to Accounting Basics. Have you ever wondered where your money really goes in a business? You might have revenue, you might even be profitable, but still run out of cash. That's where the cash flow statement steps in. Whether you're an investor, entrepreneur, or finance student, today I'm going to show you how to read a cash flow statement like a pro. Let's break it down and demystify one of the most powerful tools in financial analysis. Here's a crazy fact. A company can be profitable on paper and still go bankrupt. How? Because profits don't equal cash. Enron, Lehman Brothers, even some fast-growing startups have made this mistake. Don't be fooled by income statements alone. Learn how to follow the cash. And that's what today's video is all about. Let's start with the basics. The cash flow statement, or statement of cash flows, shows the actual inflow and outflow of cash in a business over a specific period, usually monthly, quarterly, or yearly. While the income statement shows profitability, the cash flow statement shows liquidity, how much real cash is available to pay bills, invest, and survive. It's split into three main sections. First, operating activities. Second, investing activities. And third, financing activities. We'll break each one down in a minute. But why is this so important? Because, as the old saying goes, cash is king. You need cash to pay employees, invest in growth, handle emergencies, and keep your business running. Let's look at it this way. Let's say you run a business and make a $100,000 sale today, but the client doesn't pay you for 90 days. Your income statement shows $100,000 in revenue immediately, but your cash flow statement, it shows zero because you haven't actually received the cash yet. That's why understanding cash flow gives you a much clearer picture of what's really happening in your business. Let's dive a little deeper into each section, shall we? First, cash flow from operating activities. This section includes net income from the income statement, adjustments for non-cash expenses like depreciation and amortization, and changes in working capital, your accounts receivable, inventory, and payables. This tells you how much cash the core business is generating. Here's a pro tip. A healthy company usually has a positive operating cash flow. For example, net income, $100,000, plus depreciation, $10,000, minus increase in inventory, $5,000, plus increase in payables, $3,000, cash from operations, $108,000. Second, cash flow from investing activities. This section shows purchases or sales of long-term assets, like equipment, property, or investments, loans made to others, mergers or acquisitions. Most often, this section is negative because companies spend money to grow, like buying equipment or investing in R&D. For example, purchase of machinery, $20,000, sale of investments, $5,000, cash from investing, $15,000. Third, cash flow from financing activities. This section includes money raised from issuing shares or debt, money paid out via dividends or loan repayments. This shows how the company funds itself. For example, you've issued new shares, $30,000. You've repaid loans, $10,000. You paid dividends, $5,000. Your cash from financing equals $15,000. So now that you understand the structure, how do you analyze it? Here's a quick checklist. 1. Is operating cash flow positive? If not, the business may be relying on debt or investments just to stay afloat. 2. Compare cash flow and net income. If a company is profitable but has negative operating cash flow, that's a huge red flag. Look for consistent patterns, not just one-time events. 3. Watch out for big changes in working capital. Large changes in receivables or inventory can hide cash issues. 4. Check cash flow from investing. Is the company investing for growth? That's usually good as long as it's sustainable. 5. Look at cash flow from financing. Raising capital is fine, but if a company constantly needs to borrow to stay afloat, that's a warning sign right there. 6. Calculate free cash flow. Now, this is a pro-level tip. Free cash flow equals operating cash flow minus your capital expenditures. Free cash flow tells you how much real cash is available after keeping the business running. Perfect for evaluating a company's health or dividend potential. And there you go. Now you know how to read a cash flow statement like a pro. Remember, income statements show profit. Cash flow statements show reality. If you like this breakdown, give this video a thumbs up, would you please? Hit that subscribe button and share it with someone who wants to master business finance. Drop your questions in the comments. I read every one. Thanks for watching, and I'll see you in the next video.